This is The Bottom Line. The Bottom Line on 938 Live.
Thanks for joining us on The Bottom Line. Now, Singapore's non-oil domestic exports, or NODX, expanded by 6% on year in August. This due to an expansion in non-electronic exports. Now, this following a 3.3% drop in July. Joining us now is Daniel Martin. He's Asia Economist at Capital Economics. Good morning, Daniel.
Good morning.
Now, Daniel, Singapore's NODX broke from its recent downward trajectory. What was the reason behind the latest pickup?
Well, as you said, in terms of sectors, it was non-electronics that did really well, petrochemicals and pharmaceuticals especially. Now, these tend to be quite volatile sectors because factory closures and things mess things up. So there needs to be a little bit of suspicion, but it was also quite encouraging that when we look across countries, there was quite a broad-based pickup in demand, especially China, Korea and Taiwan.
Now, Daniel, electronic shipments were again a drag on exports. Tell us more about what the issue really is with this segment. Will it bottom out soon?
This isn't really a new thing. They've been falling quite sharply for about 7 years now. Now, stronger demand from the West should probably give a little bit of a boost in the short term. But really, this is a structural issue. Singapore's economy is changing. It's moving away from manufacturing, especially in things like electronics. It's becoming more dependent on services. So I think this is going to be quite a long-term trend, even if there is some short-term pickup.
But is it anything to worry about?
Well, partly this is just a natural way of development. Singapore's now in a deindustrialization stage. At an early stage of development, you get more manufacturing, more factory output. As you progress, you get your financial sectors, your insurance sectors developing, retail sectors. So this is just the stage that Singapore is in. And these are the jobs that more Singaporeans are going to be doing in the future.
With the latest data, keeping that in mind, do you think the Singapore economy is on track to reach its full-year official forecast? It was 2.5 to 3.5% this year.
I actually think it could come in the upper end of that range, not just because of today's number. The trade data can be quite volatile, but mainly because the global recovery does seem to be on track. This doesn't mean there aren't some headwinds, and credit growth particularly needs to slow. And lower immigration is going to be a drag on the economy as well.
Now, all eyes are also on the U.S. Federal Reserve. It's due to issue a statement after a meeting ends past midnight tonight. What are your expectations?
Well, it's going to taper its asset purchases again. There's not any doubt about that. The bigger issue is whether it gives any guidance on when it might start to hike rates. The one thing it could do is drop the word in that it will leave it a considerable time after it ends its asset purchases before hiking rates. If that comes out, then the markets will start to factor in an earlier rate hike. We think it will probably be around March. At the moment, markets are thinking a little bit later.
Thank you very much, Daniel. Daniel Martin, Asia Economist at Capital Economics, joining us on The Bottom Line. The Bottom Line is brought to you by Turkish Airlines, Europe's best airline.